Hello, hello. Parker Gerard here with Evolve Advisor Group. Thank you for joining me. We will be talking through our Q1 2025 market review. And without further ado, let's go ahead and jump in with a summary starting with 2024, taking a look at our major asset classes in 2024. Really, US markets leading the way up 25% on the year, which are outsized returns and coming on the back of a great 2023, meaning back to back years of greater than 20% returns for US markets. International markets, positive as well. There has been a little bit of bemoaning within fixed income investors and fixed income markets, but our fixed income markets positive for 2024 as well. Digging a little deeper within our US equities, looking at US individual equity sectors, communications and technology leading the way again in 2024, just like a repeat of 2023. Financials and utilities doing well in 24 and really rebounding in 24. A lot of this likely due to some of the changes that we've seen within the interest rate environment. Speaking of interest rates, some of the big news that we saw last quarter was the reduction in the Fed's decision to reduce interest rates in the fourth quarter last year. Now, it's important to remember that when the Fed reduces interest rates, they reduce interest rates on the short end of the curve. So when they decided to make those cuts, we actually saw a twisting of the yield curve, meaning that short-term rates came down, but our long-term rates actually increased. So for borrowers of longer term debt, so think mortgage borrowers. So if you're looking to buy a home, you're typically looking at that 30-year fixed rate mortgage. So borrowers of our long-term debt are typically seeing some of those interest rates actually increase. Now, one of the Fed's main jobs is to try to get inflation down and into a more appropriate level. The Fed has determined that they want to target a 2% inflation rate. Now, that 2% target is important to remember is actually lower than what we've seen. It's a lower inflation target than what we've seen historically. But it's starting to look like the Fed is going to have some trouble getting down to that 2% target. They've made substantial progress on inflation, but getting all the way down to that 2% target may be tricky going into 2025. Now, what is the Fed going to do in the upcoming year? Well, I think it's a good starting point here to think that we're going to see fewer interest rate cuts this year than we did last year. Currently, the market is pricing in about one cut for 25, but again, there's a lot that can go on and a lot that can change during the year. Now, changing gears here a little bit, and let's look at our US equity markets. And one word that we could describe US markets for last year would be resilience. It's a good reminder, one of our favorite sayings here at Evolve, that markets typically climb a wall of worry. And they did exactly that last year. So despite some of these pretty big negative headlines, I mean, we saw an assassination attempt, we had an election, there were global conflict, wars overseas. Despite some of these big headlines, markets returned greater than 20% on the year. Now, we can't really talk markets without discussing the Magnificent Seven stocks. And if you've turned on the news lately, you've probably heard of these Magnificent Seven stocks. It's Tesla, Google, Facebook, Nvidia, Microsoft, Amazon, and Apple. And it's important to talk about these stocks because they really make up about 1/3 of the S&P 500. So when these seven stocks do well, the market typically does well, and vice versa. Last year, these stocks really dominated. Despite having a correction and a little bit of a cooling over summer, these seven companies really found their footing and finished the year out strong. Now, looking at next year, we may be seeing some headwinds for some of these Magnificent Seven companies. What when we ask ourselves really what led the way, what drove these outstanding stock performances over the last couple of years, well, we can really look at the earnings growth of these 7 companies. Earnings growth within these 7 companies were just outstanding through 23 and 2024. But what analysts are anticipating going into next year is more of maybe a reversion to the mean. It's much easier when we think about it. It's much easier to take $1 million company to a $2 million company than it is to take a $1 trillion company into a $2 trillion company. And as these companies are reaching new heights, it just becomes harder and harder to continue that strong earnings growth. So what we may see next year are some of these earnings within the Magnificent Seven begin to come back down to earth, as well as maybe a rebound with some of these other asset classes and other sectors where we see a rebound in earnings elsewhere. Now, I always like to finish our market reviews with a slide like this. It's an important reminder here that stocks are typically the most volatile asset class in the short run, but are typically the most stable asset class for the long run. We want to make sure that we hold these companies. We want to make sure we hold these positions for a long time. And it's an important reminder that we want to make sure that we're aligning our long-term goals with our current portfolio. And with that, I'll go ahead and wrap it up. Again, my name is Parker Girard here with Evolve Advisor Group. If you have any questions on anything that I talked about today, or maybe there's a topic that we did not touch on today that you have questions on, please feel free to reach out to me or anyone else on our team. I have our contact information here on this page. Thank you again.